Okay, I'm going to talk a little bit today about Iron Condors, another very popular trading strategy, and how you might be able to make it a little bit better, a little bit safer. Here I have the SPY, which is an ETF, and it tracks the SPX, and it's about a tenth the size of SPX. And this is a 15 delta Iron Condor. Okay, this is what it looks like. Now, you might look at this and say, okay, it's looks like it's pushing a little bit here, and you could get into trouble quick if we continue to go higher. That's because there's a lot of people are buying puts, and that inflates the price of puts. So you have a little skew here going on. So. But this is basically what it would look like, and this is a April trade. This goes out about 2 months, and as you can see, it's a 46-cent credit. So, and it's based on just one contract. Okay, $46, and your max risk is 154, $154 on both sides. So it's about a third, a little bit less than a third. Okay, what I would do to make it look visually a little bit nicer is I would probably go down to 414 on the long, so I would kind of flatten this delta out a little bit more, and that looks a little bit better right there. Okay, or what else could you do? Well, you could go here and add another. You can add another bull put spread down here, and it would have the same effect. But I just want to keep it at one contract. So this is what it would look like. So now you'd be down. You'd be looking at a $33 credit, and your risk on the upside is $67, and your risk on the downside is 167. So that would make it look a little bit better. Adjustments on these. If we continue to run higher, what I would do is I would roll up the puts a little bit higher, and if this continued to advance, I just roll up this side, and hopefully, time would pass, and this T+0 line will advance higher, and hopefully this rolling this put spread higher will make the delta flat, and it would take off some risk to the upside. So that's one way to adjust a trade like that. But again, if you're looking at a chart on SPY, this is a stock that moves up and down a lot. So 350 down here to 323, so that's like 25 bucks. So you would be able to handle a move like that if you're trading very small like this, one contract. But what you'll see if you have a move down like that, this purple line here, this T+0 line, is going to get pushed lower. It's so if I just add, say, five points on the volatility here, see how that purple line gets pushed down, and you'd be down here. So you'd be at a little bit of a loss, and the good news is you'd be trading small, so you could handle a trade like this no problem if it was to revert back higher. So let me just adjust the volatility back to 0. So they say to trade these iron condors when the volatility spikes, and you can get a lot of premium, and you can push the these spreads out further, so you can widen this trade so you have more running room on both sides. And so that's one way to look at it. And that would be the safer way to do it, is when you have a drop in the market, you would put on an Iron Condor, and the volatility would revert to the mean, and you would have a profit on this trade. As long as it didn't rip past your short. But in that case, if you're trading this small, you can just roll up that put. Same thing on the call side. If you get a big drop in the price, you can roll this down a little bit, and that could protect you to some degree. But now we're just looking at a potential loss here of $167. So it's not a lot to worry about, and you're not going to lose sleep over it. You will lose sleep over it if you are trading too big. So and that's what a lot of people might do. So, but this is a very popular strategy. I kind of like it. I don't trade these very often, but they are a pretty good strategy. It's also known as a covered strangle trade, because you're covering you're hedging your risk. So you're basically covering your short strikes with longs. So that can help. What did I want to look at down here? Okay, I kind of separated the two trades out. So let me just uncheck this, and just to see what kind of a credit you'd be receiving on both sides. This I reduced to 414, so this was $15 on $85 risk. Okay, and this goes out almost 2 months on the call side. And I would never, well, I'd never say never, but because there's a lot of gray area in trading options, you basically want to cover any short calls that you have. If you, if you need to be reminded, just look at what happened with the GameStop stock, and talk about a $5 stock going up to like $400+, and you're shorting calls at $10. You're going to get destroyed, and that hedge fund did get destroyed. I don't know if they went under. I don't think they did, but they were in a loss for billions of dollars. So always, well, again, do what you want with your money, but always cover your short call positions, and that would be very wise to do, because the stocks can go to the moon, and you're short a call naked, and guess what? You'll definitely get a margin call, and that will probably save your life. And but anyway, that's the bull put. So in this example, we're getting 18 bucks on $182 risk. So that's about 10%. And I put in the strangle trade down here to show, again, don't ever trade short calls naked. But I just wanted to show, this is what the trade would look like if you would just short those strikes, at 348 and 413, and your credit would be 515 bucks. But again, this T+0 line with an increase in volatility, these are all negative Vega trades. So, this purple line will get pushed down with an increase in volatility. So if you suddenly have a market that's starting to drop dramatically, it's just going to push that line lower. So, but what I would suggest is to follow along with Tasty Trade, they have this trade called a jade lizard, okay, where you don't have any risk to the upside. In this example, I'd sell the strangle, and you'd have this extra long here at 415. So your upside, you would not be a problem because you're covering it, and you would never have a loss to the upside. And you would be taking in $382 in this example. Okay, this is going out about 2 months. And you know, this would be a better way to trade, I think. Um, these Iron Condors. This is probably a trade that it's not going to blow up your account as long as we don't crash, and you know, I mean, there's nothing that's guaranteed with trading options, nothing at all. But you could look at any stock and kind of do something similar. I'm just using SPY in this example, but um, those are ways to make an Iron Condor a better trade. Um, Now, I say only use one contract, but if somebody was to bump up contracts, you know, say you had 20 contracts going and you're gonna hoping to make $660 on $3,300 risk, um, you could do something. You can customize it where you're buying a few more longs, um, and it would look something like this. So you'd have a back ratio and another back ratio spread on both sides, and you'd still collect a credit. And depending upon which way this market moved, you can sell off that extra long that you bought, or you can sell another um, contract. So obviously, the more contracts you trade, you do have more things you can do. Um, but see how you keep this T plus zero line pretty flat. It does sag a little bit here, but um, and over time, it's gonna take the shape of this expiration. So, but you're not going to be trading anywhere near expiration. Hopefully, you close this out well in advance of expiration. You know, I would never trade the front month, but uh, that is something that you can consider and on making a trade a little bit safer. And that's just a couple options for you. I hope you enjoyed. Have a great night.